Good afternoon, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. I'm here with my colleague, Allison Schrager. She's a senior fellow at the Manhattan Institute, and John Lear. He's the chief economist over at Morning Consult. We are here for a little chit chat about Fed Day. The Federal Reserve is going to drop its policy decision, the FOMC policy decision, in just about 5 minutes. The expectation here is that we will not see any change in the policy rate. It will stay at 3.5% to 3.75%. However, all eyes will be on any signaling about where they go from here. Of course, we'll be very keen to understand how they are thinking about the latest energy shock. Of course, all of this is unfolding against the backdrop of the U.S.-Israeli campaign in Iran, and it has sent energy markets all over the place. And so we're trying to understand from a central banking standpoint, what do they do about this? So, John Lear, let me go to you. You're the guy with all the real-time analytics as to how consumers in the United States of America are thinking about inflation, how they are feeling in terms of their attitudes about the economy. What are you seeing? How are folks processing this?
The consumers and consumer sentiment in particular has certainly fallen since the U.S. started this campaign. I suppose campaign is the word we're using, so I'll use that throughout. Starting the campaign against Iran. I think it's been surprising that sentiment hasn't fallen further, given the potential for the war to drag on or for the campaign to drag on. But again, I think that reflects pretty high-level uncertainty around the duration and intensity and what it means for gas prices. My expectation is that when you see sort of a persistent signal at the pump or other price indicators, that sentiment will fall further. And on our high frequency inflation expectations reading, we really have seen very little uptick over the past few weeks. And so again, I think many consumers are still waiting to see what the kind of outlook looks like for this campaign, and then what it means for gas prices and prices more generally.
Yeah, just to give folks an idea, this is your company's metric here. This is the consumer sentiment daily indicator. It's a 5-day moving average, and that does look like a meaningful drop off here. But I guess what would we want to do? Maybe go back to 2022 and see what happened when Ukraine was unfolding.
Yeah,
not like that so far, right?
It's not like that. I think there are some reasons why that's the case. Primarily, consumers took a pretty significant shock in late December, early January as the labor market weakened. And so I think one of the things right now that consumers are trying to get their head around, in addition to this campaign in Iran, is also what's going on domestically in terms of the labor market. And then obviously at that point in time in 2022, we also had kind of runaway supply chain bottlenecks that were starting to drive up prices as well. That kind of showed, regardless of what happened with the war in Ukraine, that there were going to be some pretty significant supply disruptions driving up inflation.
Yeah. Okay. So we've got a minute until the decision comes out here. Allison, what are you looking for in terms of signaling? What will you look for in the statement? What do you want to hear from Jerome Powell?
I mean, I guess it would be a sense of his outlook and, how he expects, what's going on in Iran to sort of, if it's going to limit. I mean, I think we were looking at a very sort of highly likely couple of rate cuts, and now we're not. So I'd see how much his demeanor has changed, how much his outlook has changed, and if he's talking a lot more cautiously about that.
Sure.
All right. It's important to note, right? We're going to have two things, right? There's the Iran war, what that means, the spillover for core PCE. We'll get that in the summary of economic projections. It's not that long ago, we also had this pretty historic Supreme Court ruling on tariffs. And so there's a lot of kind of counterbalancing forces. It will be interesting to see how the committee thinks on net that will affect some of their core indicators.
Yeah, absolutely. All right. Well, I'm just going to give it a couple seconds because the decision is due now. So, as expected, the rate decision comes in. They hold at 3.5 to 3.75%. I'll take you over real quickly to your market reaction. So you see off of the back of this. Actually, I'm sorry, that's not populating immediately. So you see S&P 500 stepping up a little bit. This is the yield on the 2-year Treasury note stepping down a little bit. Let me see if I can get you some headlines here. So as per our Bloomberg blog on this, the Fed says implications of Middle East developments are uncertain. Fed says Governor Stephen Myron dissents in favor of a rate cut. And the Fed maintains projections for one rate cut in 2026, one in 2027. So not really a lot moving around here under the surface. You know, Allison, this sort of feels a little bit like let's all hurry up and do nothing here, kind of situation. Like a lot of macroeconomic variables are moving around, but of course there's this orthodoxy in central banking and macroeconomics that you're supposed to look through a supply shock, and it kind of sort of looks at first blush like that's what they're doing here. Is that the right approach?
Yeah, I mean, this might be the least surprising decision ever. The thing is, I mean, we might not have a supply shock. We just don't know how long this will last. Jason Furman has a nice column today talking about how we're not exposed to oil like we used to be. And, the labor market, might be weakening. So, I mean, there's every reason to just sit and wait and sort of see what happens. I mean, I think there's a lot of reason not to expect a supply shock like we had in certainly in during the pandemic. But arguably, the Fed's not supposed to do anything about that anyway. So I think some people would argue that the reason why we had so much inflation is they were pouring so much fuel on that fire. So if we had a rate cut today, that probably, would be, one, a surprise, and two, not seen as particularly prudent, potentially politically motivated, because, when the labor market's weakening, but not awful, and, you might have some inflationary pressures picking up, it would make a lot of sense just to sit and wait.
Right. Okay. All right. So there you have it. Not a big move here for us. So John Lear, you were mentioning before, you said you were a bit surprised that your metric of inflation expectations was not moving around a heck of a lot coming into this decision. Unpack that for us. Why is that surprising to you? What are the risks to what the numbers are actually showing us right now? How do you think about that?
I think, over the last 6 years, we've seen a pretty strong correlation with gas prices and our measure of inflation expectations. It's a weekly measure. And so you get to pick up on a lot of this sort of high frequency shifts. When gas prices spiked higher in 2022 with Russia's invasion of Ukraine, we saw our measure of inflation expectations also jump higher. That has not been the case more recently. And so even as gas prices have started to spike, inflation expectations remain fairly well anchored, and they're kind of continuing to follow this broader downward trend over the last 12 weeks, let's call it. In some of our data, like you showed the sentiment data earlier, clearly folks are on edge. They're worried about this. Similarly, see that they're encountering higher than expected gas prices when they go to the they go to the filling station to pump up, but they don't know yet what to make of that in terms of what it means for inflation. And again, you do have these kind of counterbalancing forces with there's obviously the oil supply shock, question around how long that lasts. But again, you've got tariffs kind of counterbalancing that, and you've got a fairly clear kind of path or off ramp for tariffs, and the potential, I think, that you're going to see businesses avoid some of the pass through as it becomes a temporary phenomenon. So I think consumers, much like energy prices, are waiting to see how this conflict plays out before they update their longer term outlook. And that again seems prudent to me. you mentioned earlier, you asked Allison earlier about sort of whether or not it was wise for the Fed to not make a big change. I think one of the mistakes that has been made is offering too much forward guidance in these periods of elevated uncertainty, and that you kind of box yourselves in. And it just doesn't make sense right now to try to convey to markets where the Fed thinks things are headed, when I don't think anyone honestly knows where this campaign in Iran is headed.
Yeah,
Yeah,
I mean, I think if you read Rich Clarida's sort of post-mortem of the inflation that went wrong in during the pandemic, it was forward guidance that he thinks was the big issue, which is that, you know, the Fed committed as part of its framework review that it would keep rates near zero for any weakness in the labor market. And then you had this big takeoff of inflation. And, you know, that's potentially one reason why they kept rates near zero, as inflation just took off. So I like to hope they learn their lessons. At the very least, I think Kevin Warsh is more skeptical of forward guidance, of the dot plot. So we might get a little bit less of that. Of course, it will be interesting to see how that interacts with expectations, because the whole idea of having, you know, charting out your course is it's supposed to stabilize expectations. And I think one sort of something I don't think we appreciate so much is if you look at the New York Fed's survey of inflation expectations, you know, they're pretty low. It's like John was saying with their measure of inflation expectations. We see this everywhere, of them not being nearly as elevated as you would expect, considering everything that's going on. But we do see the New York Fed asks people how confident they are. And that's been elevated since 2020 or 2021, which just suggests to me that inflation expectations might look well anchored, but they might not be as stable. And, you know, perhaps we had this bad brush with inflation. People had never experienced it before, but eventually went back. So people are like, all right, I'm not that worried about inflation. But if we have another spike, that could really make expectations like de-anchored for much longer and give the next Fed chair a much harder job.
Yeah, I was at a conference last week, the NBR conference, where they were talking about just this phenomenon. We talk about inflation expectations being anchored until they're not, until actions don't support the broader mandate. And for as much work has gone into try to drive expectations to be anchored, they can also become unanchored, and then it takes quite some time to get them re-anchored. And so there is that risk, right, that they lose some of the credibility that they've built up. And I think you're seeing that right now in their hesitancy to look too far into the future when the present remains so uncertain.
Wouldn't it be something if Kevin Warsh turns into like the next Paul Volcker? Like, we have something bad. He's just like, I don't care about the politics. I'm going to take the economy into a recession to bring inflation expectations back. Like, I would have never expected that. Like, I feel like I've been aware of Kevin Warsh since like, whatever, 2005 or whenever. And that would just be like not what anyone expected, but like I think could happen. And that, I don't know, it'd be something.
I have to say, I'm looking now at their updated summary of economic projections, and their estimates for core PCE have jumped significantly higher.
Really?
From when they updated them last in December. So now it looks like the median estimate is 2.7, and it was 2.3 in December. And so, you know, that to me, it looks like they just see it as being a short-term phenomenon, but I think that gives you a pretty strong signal that
Still, doesn't that exclude energy?
It does exclude energy, yeah. So they think that somehow there's going to be some spillover, though, I think, from
through travel and
Exactly.
things of this nature. So to be clear, their estimate for headline PCE, they see that stepping up. They now see it ending 2026 at 2.7%. Which is up from 2.4%. They also are revising core PCE up to 2.7% from 2.5%. And like weird things can happen in these statistics because I mean, we're just citing the median. Different people have different projections. But as John says, that's not encouraging. I also did want to put up another interesting data point here for the folks. This is the number of participants on the FOMC reporting that they believe the risks to their PCE base case are weighted to the upside. So just about everybody is back to saying that the risks are weighted to the upside here. So, you know, they're writing down 2.7%. That's a little bit worse, but it's also not terrible in the grand scheme of things compared to where we were during Ukraine and stuff. But they're noting they might be wrong. And if they are wrong, it's going to be in one particular direction, right?
Maybe because they're wrong all the time. They're just going high.
I mean, the other thing I think about this is, I mean, like, geez, I don't know if there were really any answers. I'm obviously not sitting in the seat. We're not sitting in the seat. But the fact of the matter is, we just know that central bankers are kind of helpless in the face of these supply shocks. And like we were talking about the 2020 experience, and then we talk about what happened with another supply shock in 2022. We can throw in tariffs as a supply shock. Like the commonality between all of these things is that the central bank seems, at least in the first instance, to resort to doing nothing, right? They sort of say, well, you know, the orthodoxy would say we shouldn't respond to a supply shock, so we're just sort of going to twiddle our thumbs. But doing nothing is an active policy decision, isn't it? Actually, I mean, is that just giving them sort of you know, plausible deniability if something goes wrong? Like, I mean, they kind of did the same thing in 2020, right?
Well,
in 2020 they had an emergency meeting and they dropped interest rates down, right, to zero. They preemptively.
Yeah, I misspoke. I mean, I'm more thinking about 2021 and their lack of a response. You're absolutely right. 2020 was a very active period in monetary policy.
Yeah, then it was like keeping rates low in spite of high inflation is doing something. But like when I learned monetary policy in grad school, one of the first things I learned is that bad monetary policy is always bad, but it's really hard to find examples of good monetary policy. So it's doing nothing is usually better. I mean, unless you actually are facing like depression level like situation, like if they did nothing during the financial crisis, that would have been really bad. But most of the time, you don't want to be this activist Fed, because usually they make things worse rather than make things better. And, you know, like inflation and unemployment are both kind of reasonable right now. So the case to get ahead of the curve and do something is, I think that bar is always very high, and you don't want to get ahead of it.
Yeah, can I just say real quick, this is why nobody wants this job. Like, Allison, you're right about that people have that impression about central bankers, but yeah, like people only criticize central bankers.
I would just say, I mean, it is certainly the case that holding rates steady is actually some sort of a decision in a world where inflation is changing, right? Because then your real rates are evolving. In this case, holding rates steady with inflation persistently elevated above policy, not really dramatically moving, that feels to be more of a kind of a justified punt, if you will, than holding rates steady in a world where inflation is dropping and essentially you're tightening monetary policy.
Yeah, fair point. I want to switch over to the statement real quick, if we can, since I have it up on the screen. You know, it's going to be really important today to just parse language to understand how they're thinking about this. So this is our first bite at the apple. This is the policy statement, and what they say isn't going to surprise anyone. They say available indicators suggest that economic activity has been expanding at a solid pace. Job gains have remained low, and the unemployment rate has been little changed in recent months. That's a slight change to the characterization. They had said that the unemployment rate had shown some signs of stabilization. Inflation remains somewhat elevated. That last line is exactly the same as it was in the previous addition. And then we have some new language in paragraph 2 characterizing what's going on in the Middle East. They say the committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. That's boilerplate. Uncertainty about the economic outlook remains elevated, but here's the key new part. The implications of developments in the Middle East for the U.S. economy are uncertain. Indeed, they are. That's what John Lear and Allison Schrager have been saying on here. And so there you have it. Again, sort of to my point of like, let's hurry up and do nothing. We have a lot of pieces moving around geopolitically here, but basically they're not changing their forecasts. They're certainly not changing the policy rate, and they're really not changing their language so far, at least in this first bite at the apple.
You see some greater signs of consensus, though. I think that's noteworthy, right? So Governor Waller has changed and agreed with kind of this broader consensus view. So there's one dissenting vote.
Yes, he's no longer in the running for the Fed chair gig as well. That may have helped bring him into the consensus, although I'd just be speculating on that.
There's also just less of a case to do anything. I mean, I think if they cut rates right now with these inflation risks, and I think John makes up a good point. Like, even if this is short, even if we're not as exposed to oil like we used to be, even if a lot of this is hedged, the salience of seeing the higher prompt prices can really impact expectations. Yes. So to cut now, I mean, I always, Stephen's usually smarter than a smart guy. So I always think he has reasons I might understand, because when you actually talk to him, he always manages to sort of convince you. But, you could argue, okay, the labor market's weak. He's convinced that oil prices are going to go back down. That would be a case. But, I would be surprised if everyone got on board with that. But to actually increase rates now, because you would see inflation coming, would be an even bolder step. So, there's less this is kind of more of a no-brainer. Let's just sit and wait.
Yes. John Lear, one of the things that is really interesting to me, Allison is talking about the psychological salience of what goes on in energy markets. Your metric breaks things out by income cohorts, and even that 100K plus earning cohort is reacting negatively in terms of their sentiment to this. That's it's interesting to me because nobody likes to pay more for gasoline, but if you're making 100K plus, maybe that extra dollar or so at the pump isn't as big of a deal on your actual budget, but nevertheless, it does seem to hit them psychologically as much or more than other cohorts. What's up with that?
Yeah, I think it's primarily driven by their disproportionate exposure to the stock market. These groups have are much more likely to have $200,000 plus invested in the stock market. I think the history of recessions in the post-war period is one where they are largely, I don't want to say caused by, but correlated with some sort of global conflict or engagement. And so it's not surprising to me that folks who are invested in the stock market right now are very concerned about what that could mean for their personal finances and the country as a whole.
Yeah. Okay. Hey, I want to remind folks, we've got about 10 minutes to go until the Jerome Powell press conference, which we will be carrying on this stream. So you can just stay on this stream and we will have the Powell presser for you. In addition, in the final 10 minutes here, if you want to send in questions, we would be more than happy to answer them live on here. John and Allison can weigh in. So send those in if you are interested. Right. What happens in the stock market is important for sentiment, as you say, John. This has been a bit of a different stock market reaction than we've seen from other Trump shocks, as it were. If you look at the tariff shock, for instance, it was a real kind of V-shaped sell-off. It was stunning in early April 2025. We sort of kissed an almost bear market briefly there, but then huge, rip forward in the S&P 500 after just about 3 days. We went into full-on recovery mode. This feels like more of a grinding correction. The market hasn't really been able to bounce. John, do you think that consumers react differently to different kinds of weakness in the stock market? Have you seen anything in the data that would guide us on that?
Yeah, I mean, there are a couple of things. One is there are certain periods of time where consumers and investors look at the world very, very differently, right? So you could think about actually AI is a great example where that can be a very positive thing for investors, for margins, corporate profits. Could be a net negative for workers and near-term employment prospects. And in fact, we saw that at the end of December in our data pretty starkly, where the stock market was in a really strong spot, but high-income consumers turned very negative as their job loss expectations spiked higher on fears of AI. So that's part of it. I also just think in this particular case, right, the ability of the U.S. to exit from this engagement, it's unclear what that sort of off-ramp looks like or what that path looks like. Whereas with the trade wars and tariff wars, you could kind of see this playing out where there were policy negotiations that took place. There was a lot of sort of behind the scenes negotiations behind the top line pronouncements. It's unclear, I think, how this is going to play out. It seems unlikely that Iran is going to, lay down and coalesce or somehow reach some agreement with the Trump administration where they're going to change regimes.
Yeah, it just seems like a kinetic conflict is so much less predictable, right? I mean, so much of 2025 was like the market action was driven by Trump's comments, and he could make a comment and he could walk it back. And this does not feel at all the same. I don't know about you.
Harder to walk back a bomb than it is to walk back a policy announcement.
Yes, that is brutally true. We've got a question coming in from TikTok, and this is an interesting framing. The listener asks, wasn't Powell late to hike rates after the Ukraine war started, after Russia invaded Ukraine in 2022? There's sort of a lot to unpack in that question. Either one of you want to take a swing at that one?
Well, I mean, he was late because inflation had already taken off for other reasons too.
Right.
So, I mean, by 2022, by the time Russia attacked Ukraine, he was already late. Right. I mean, that inflation had already left the station less. I mean, and honestly, I mean, Ukraine, had a big impact on energy prices here, but a much lower impact on inflation than it did in Europe, just because, we are a little bit less dependent on, energy from Russia, although it is ultimately, we did feel some of it because it's a global price.
Yeah. Anything to add, John?
Yes. I mean, the short answer is yes, but for all the reasons that Allison outlined, which is it was not driven entirely by that, right? The lateness was not the Ukraine war per se. It was broader, I think, having this perspective, still being in this secular stagnation mindset where you're very hesitant to raise rates. You're very afraid of hitting the zero lower bound. So I think there were some other kind of framework challenges that prevented Powell and the Fed more broadly from acknowledging the challenges that they faced.
Yeah, it's interesting to see what we had basically in 2021 and 2022 were these clusters of shocks coming together, and it's interesting to think about how monetary policy would have reacted to that particular energy shock if there wasn't this whole other series of shocks going on in the background. But I don't know if we really understand the answer there. I mean, it seems pretty clear to me that what happened with Ukraine exacerbated a a problem, and all else equal may have led to higher rates at the end of the day. But I don't know that there's much more that we can say concretely beyond that. What do you think?
Well, there are some very important differences between what was going on, in February 2022 and what's happening now with Iran in terms of the domestic economy. So
Yeah,
just
unpack those, John.
just to unpack that quickly, this was sort of the focal point of my note this week is one, the labor market was in an entirely different position, right? So at that point in time, there was labor hoarding. Companies were holding on to workers for fear that they couldn't find enough of them. Wage gains were very high. It was a extremely robust jobs market. On top of that, you had household finances. People were flush with cash coming out of the COVID period, and then also coming out of sort of the lockdowns.
Mhm.
And then you had the third phenomenon was kind of this unlocking experience where all of a sudden the services sector was now open for business and people were starting to engage in revenge spending, really going deep and trying to make up for sort of lost time that they experienced in 2020 and 2021. And so there was a lot of pent up demand essentially at that point in time, which is, I think, not what we're experiencing right now. And so my prior would be that even if we were to have a supply side shock in the form of elevated gas prices, I don't think that is like, just additive to nominal demand. I think it is more likely to be a drive substitution and trading down as opposed to just elevated purchases.
Right. Okay. Allison, any further thoughts on that?
No, I mean, it's it. I think we're definitely in a very different economy. I mean, to some extent, even what we're seeing now is still a hangover of that time. And, if you're a traditionalist with monetary policy, you respond to demand, not supply. So I think that's why the error, which I still haven't forgiven Jay Powell for in 2022, it was mainly about sort of still continuing to pump up demand in a supply constrained economy.
Right. Okay. So we have about 3-4 minutes until the Powell presser starts, and once again, we're going to carry that here. If you have any questions for us to address in the final few minutes, we'd be happy to weigh in on those. In the meantime, let's say we are Jay Powell's speech writers. What are the messaging priorities here? Like, what is the right way to do the job? And let's not forget, these are the waning days of Powell's chairmanship, right? So he's juggling that challenge, and he's juggling the challenge that, as we've been talking about this whole time, he doesn't really know what's going to happen with this energy shock that's unfolding here, and so he has to balance sort of transparency with the reality that suggesting that he knows what comes next is actually misleading. How does he juggle all this, John Lear? What does he say?
Well, he'll certainly describe uncertainty. I think we could all take some bets on how many times he'll talk about uncertainty in the markets. Just looking at that comparison of the statements, I guess I'm surprised that they didn't talk about policy uncertainty more broadly. And again, I think that is in many ways, I think many academic economists and policy economists are still focused on tariffs and thinking about what that means and the pass-through costs of tariffs onto in good prices and rebates. I mean, there's a whole slew of unanswered questions there that have pretty direct implications for setting monetary policy. And then how do you take those and weigh those against the most likely outcome from the Iran campaign and what that means for energy prices? So I would hope that he doesn't sort of over focus on the here and now and does some work kind of contextualizing this moment in terms of where we've been over the last year.
Yeah. Allison, what do you think? What's the best way for Powell to handle this?
I would say there's a lot of uncertainty, but we are here to do whatever it takes. But right now, that requires doing nothing.
Okay. Are either of you surprised? I'm just looking at the distribution of the forecast for the Fed funds rate in 2026. Are either of you surprised that no one's talking about raising rates at all?
No, I mean, this is still a
crickets out there.
It's a dovish Fed. It's still is, That's who they are. Maybe Beth Hamrick, she'll be the first one to break. That's my bet.
Yeah, I think the downside risks are also very imminent. And, 6 weeks ago, I think we would have all been talking about weaknesses in the labor market and the shift in tariffs. We would have sort of become less focused on inflation. So to some extent, this is like they're trying to finish the job of getting the genie back in the bottle, so to speak, and taming inflation, while also making sure they don't crush the labor market.
Yeah, I'm not saying it would be my base case, but of the 19 members of the FOMC, I'm surprised nobody is even hinting at it. Folks, the press conference is starting, and so we're going to send you over there for the actual comments from Jerome Powell. Thank you very much for being with us.
American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Colby. Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net, we didn't make progress. And if you look at total core inflation, it's about 3%. And some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind. And the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially, it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But that wouldn't be most of core, right? So the oil shock for sure shows up here. some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people tied up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, are you not rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. It's something quite different than that. We might have much lower than expected pass through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just, you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just, we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increase to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is, there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much of it happening now, but some of that could happen over time if you see that. But So the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully. But of course, that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things. And you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that. And we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick.
Nick Timmeros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay, so I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks. And we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year rather, is continued progress in housing services, finally seeing that, the goods inflation come back down, because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable. And, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, we're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent would you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply side story, has changed despite the quite negative number in February. Would that be the right take? And was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and so are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common? And does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, it has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January, some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question now?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy.
You know, you can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens. And it'll come down to how long, the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there is tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have employment really close to longer run normal. And we have inflation that's, 1 percentage point above that. So calling that stagflation, it's not, I would reserve the term stagflation for, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s. And I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth.
Thanks much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
we don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course, people will feel that. But I don't want to speculate about what that might mean, because honestly, that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do. But in this case, we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023, when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is, our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history. And then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc, and for all the tariffs, they can say, well, so we have a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases, and we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to move they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris,
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value perhaps in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction. And so I just think we do it. And, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because it's subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and what it does for us is makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and stable prices is half of our mandate. It's one of our two mandates, the maximum employment being the other. I mean, look at every advanced economy, anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Richard.
Hi, Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or a specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices, so your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, you know, the cost of food and other goods that really rely on it to.
So I think it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but you know, we're right at the beginning of this and we don't know how big we just don't know how big it will be and how long it lasts. You know, it may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. You know, we actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of, you know, generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity. And by the way, expect it to continue. And we haven't really started to see the effects of generative AI. And that should certainly contribute to that. So it's quite unusual. And it's, you know, this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story. And if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates?
I think you have to be cautious about that. In particular, if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere. And that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side. And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.